Welcome to the MUFG Global Markets Podcast. I'm George Goncalves, MUFG's head of U.S. macro strategy in the Americas. And today I'm joined by Andrew Myers, our desk analyst from the investment grade team, and Bill Matthews from the desk analyst also from the high yield team. We're recording this as of Thursday, January 4th, 2024. Happy New Year to both of you guys. Welcome to the podcast.
Thanks, George. Good to be on with you today.
Happy New Year, George.
Great. Thanks for joining, guys. Again, it's it's really good opportunity to have you both as we do this virtual fireside chat. Lots going on in credit. We covered a lot of these credit themes in 2024 Outlook that we recently published. So let's jump right in and start off with you, Andrew. Given the key factors that drove the tightening in 2023, why don't we kind of quickly go through as a recap of what were the best sectors and what led to that sort of outperformance?
Sure. Well, I'll start with sort of a recap of what happened in 2023. I would say first, IG investors went into 2023 defensively after a sizable 35 bip rally off the highs to close 2022, and expectations were for a robust new issue calendar in January, and then there was general uncertainty around the Fed policy and the direction of the economy to start the year. So IG investors were somewhat defensive, but I think what we saw in the first month of the year was quite telling and set the tone for the remainder of the year. That is, heavy new issue volumes were met with strong demand, supported by ample cash held by investors. Issuance was somewhat skewed to financials, so there was some technical support for industrial credits. Equity markets rallied, signaled a general risk-on tone, and this equity credit correlation was maintained throughout the year. And in the end, IG cash index actually tightened 13 bips in January, despite the heavy issuance, and delivered really strong returns. I would also say that throughout the year, widening in risk-off scenarios was limited for a number of reasons. Investors were unwilling to sell discounted long-dated paper. The buy the dip mentality was strong as ever and supported by investors eager to deploy cash at yields not seen since the financial crisis. And I think the federal government's response to the regional bank crisis in March sort of increased general optimism, and that March rally renewed some of the FOMO idea. And I guess lastly, we can't ignore resiliency in the economy, perhaps propped up by fiscal spending, but consumers remained strong throughout the year, and monthly labor reports proved to be resilient. So that was sort of how the year went down. And a couple of sectors that outperformed. I think media was the big outperformer, ended 47 bips tighter on the year. And while the entire IG market performed really well, it sort of proves that it's still important to be a good credit selector. In this case, you had a couple of idiosyncratic stories. You had the post-merger deleveraging story of two of the big studios, a storied but struggling media co coming off the brink of high yield that led to big spread tightening. In general, broadband providers posted solid results despite concerns about slowing sub-trends. And then you had the addition to the IG index of the largest streaming provider and subsequent 100-bit rally in that credit. Another sector that performed well was the telecom sector. They came off some large investing and massive debt issuance in 2021, 2022, and they started to execute on leverage reduction, and couple that with market share gains in broadband with fiber connectivity, competing with the broadband providers, and that provided some good outperformance on the telecoms. And then away from communication sector, basics did very well. Again, I think somewhat of a idiosyncratic story there. Large chemical producers saw spread out performance. And I think this is because the chemical cycle is ahead of the general macro cycle. That is, there was a supply glut in 2022, and they sort of cleared that inventory out going into 2023, setting that sector up for stronger financial results and subsequent spread performance. Tech, of course, you can't ignore tech, but the AI craze, 38 bips tighter for the tech sector. And then lastly, energy propped up with oil trading at elevated levels for much of the year and consolidation in the E&P space, which continues to be a theme going into 2024.
Thank you, Andrew. That was really comprehensive. Really appreciate you going through all those details. Let's flip it back to you then, Billy, on the high yield side. What were the big themes in high yield and which sectors performed? Same question. Give us a good recap.
Sure. Yeah. So on the high yield side, high yield reached its widest yield in kind of recent times in October 2022, with the yield on the index exceeding 9.5%. So by the time we came into 23, though it had rallied, it still started at a very wide point. So the setup was good from a technical perspective. We had the Silicon Valley Bank and the regional banking crisis emerge and kind of pass more quickly than people had anticipated. And then even with the monetary tightening, credits were able to withstand the higher interest rates, and performance in the high yield market was better than expected. So, the high yield market returned 13.5% for the year, and spreads ended the year kind of a historical tight level of 340 basis points. So going into 24, despite the historical tight levels, we still are constructive on high yield, in that, now we're facing a declining rate environment, and high yield investors, traditionally are all in yield investors, so should be able to take advantage of some of those declining yields. And that's partially, I think, why spreads are as tight as they are, as people, want to have exposure and maintain exposure despite what would seem rich spread levels. So on a sector basis, clearly financial institutions did well. The total return across sectors was pretty uniform, with all sectors, approaching double-digit returns. Energy, basic industry, capital goods, technology. Pharmaceuticals had some credit-specific implosions, so their returns were mid-single digit. But aside from that, strong across the sector space. And so going forward, I think we feel that a loosening of the supply chain constraints, which had been thematic in 2023, will help global production schedule. So we're favorable towards industrials. In cable and satellite, there was in telecommunications, there were a couple of credit-specific debt exchanges that avoiding those was critical in terms of maintaining good performance in high yield portfolios. And I think if switching to issuance, $175 billion of issuance was kind of the projected level for 2023. It came in at about 178 billion, so right on the prediction. And for this coming year, we are predicting kind of a 210 to 240 issuance, so an increased level, but still below historical levels. And so that's the high yield side.
Thanks, Bill. I really appreciate that. Let's shift gears a little bit, and you kind of touched on these topics already, Bill. So we'll focus more about our bull base and bear case and bear case for spreads and overall macro rationale behind them. I'll kick things off, and then I'll turn over to you guys. But for those that received our 2024 outlook, we had a cross-market view summary forecast range where we expect the Fed to ultimately deliver nearly 200 basis points of cuts, 175 starting in March, with really the contentious view is March really the start, and if they push it back, they'll just ease less than the full 175. But we do think that short end rates are going to go under 4% as a result of that. But at the same time, the general rate curve has anticipated this move, and we've had a pretty decent rally in rates in Q4. And so our range for the 10-year as a base case is somewhere around 3 3/8 to 4 3/8. If we get a backup in rates, it's going to probably happen in the first half of the year, more so than the second half of the year. But that all will also depend on what sort of outcome we get from the election. But nonetheless, we think that most of the move in rates has largely happened for long-term rates, unless we go into a much more protracted slowdown. And then on spreads, we penciled in 95 to 140 for IG and 340 to 490 on high yield. And so maybe starting with that and just kind of exploring our rationale that even though we're relatively constructive from like an aggregate level, spreads did get pretty tight to finish the year, and now it's more about trying to really pick our spots. And so I'll turn it over to you guys to kind of think through like how to think about the range of like 95, 140 for IG, and for high yield 340 to 490. Andrew, you want to go first?
Sure. Yeah, starting with IG. I mean, starting the year at some pretty tight levels, around 100 bips, although we've moved back in the first few trading days of the year to about 105 bips on the index. And so I think, our ranges have little upside built into them. I think post-pandemic, when the Fed was buying bonds or had bond buying programs, the tights we saw was like 79 basis points. So wouldn't expect to get close to those levels, given that those Fed programs are no longer in place. But there could be, some tightening there. But I think most of our ranges have a little more downside built in, just from where spreads are starting. Bear case, we could see it going out as much as 180 basis points. I would say that last year, when we were looking at sort of recessionary scenarios, we thought maybe spreads could get to 200 or even wider than that. I think one of the takeaways from 2023 is IG credit markets are in a technically strong position, and I don't think that widening would be as severe in a bigger bear case. And on the bull case, yeah, I mean, we're already at tight levels, so I don't know how much tighter you can go. I think throughout most of these cases, you still have a pretty good opportunity for total returns. I think in the end, the Treasury story is going to be providing a lot of tailwind for IG investors, and there's going to be great opportunity for IG returns with modest potential for spread widening.
Thanks, Andrew. Yeah, definitely agree with you on that. And I do think that the downsides, the way we've kind of carved out these ranges, it's more about when to buy the dip more so than to be terribly concerned. But at the same time, there'll be times where treasuries can maybe outperform IG as well. And that's where the spread widening will come more so than actual credit concerns. Billy, how about you? Like moving over to high yield, I mean, we got kind of similar stories, but a much wider range for different reasons.
Yeah, similar story in that the last 2 months of the year, you kind of mentioned November, December were, a blistering rally for high yield, and particularly, after the December 13th Fed meeting, where I think 40% of the spread compression for the year was in the last month, and maybe 20% of that, 25% of that was within the last 2 weeks of the year. So we, not a surprise, we've begun the year on a note of weakness as we're giving back some of those gains. But in general, our spread ranges kind of begin with where our existing levels are right now, about plus 340, and then depending on which scenario evolves, a widening range in the more distressed scenarios out to 640, and a bull case kind of in the 415 plus 415 spread level range. So in general, I would say thematically, the high yield index has become slightly shorter in duration and has become higher in quality, and also a bit smaller as an aggregate level. So those factors have kind of contributed to a generally higher quality index than has been the case traditionally. So that will be somewhat helpful in terms of scenarios where we enter disruption. And I think, kind of strategically, the proper way to kind of address the risks is to remain defensive in what I would characterize as harvest the value premium, meaning remain defensive and wait for dislocation, and then use those opportunities to move down the credit spectrum. If you think about high yield credit portfolio risk on three axes, credit, duration, and concentration. Duration would probably be the axis where you could extend and would be rewarded for that. So again, we would favor double Bs, which would allow you to kind of create a portfolio that would have below index risk and then yield above index returns if, during those periods of dislocation, you move back down to single Bs. That's how we would approach the market. And if you think about, from a default perspective, something we haven't really touched upon, defaults did rise to 3%, including distressed exchanges during 2023. And we expect that to tick up a little higher, but that's still below the long-term average, which would be between 4 and 4.5%. So despite the disruption and the global macro forces that we've discussed before, high yield credits have been able to weather these forces and continue to cover interest, meet maturities, and generate free cash flow.
Well, guys, thank you. Thanks again. I mean, this is really comprehensive. Really appreciate everything, Andrew and Billy. Let's wrap it up here.
Thanks a lot.
Thank
George.
you. Thank you, George.
Great. And again, I encourage our listeners, for those who have not had a chance to read the U.S. Desk Strategy Report, where both Andrew and Billy contributed to, which was called the 2024 U.S. Outlook Getting Back in Sync, where we had a high yield as well as IG section covering a lot of these topics, as well as charts that clients will find interesting. Also like to remind our listeners, for those that would like to receive our strategy reports directly, please email myself or your MUFG sales coverage. And again, thanks for listening for the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the global markets rumors.